All right. Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns while keeping you up to date with everything that you need to know. What helps investors beat the market is information and knowledge of how to use it, and we'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications, because every time we drop a new episode, money is made. All right. Um, okay, so tonight's conversation is about the technical footprint. Now, here's the deal. As I stated earlier, I'm going to be showing you guys quite a few things tonight. Not every one of these things has to be a part of what you do. I want you to really think about, what did he show me tonight that seems to be something that I could do on a regular basis, given my schedule, whatever it is, like whatever that you have, like whatever you have going on that, like you need to focus on a regular basis, however you plan on being as an investor, so on and so forth, right? What are the things that make the most sense for you to adopt? That's what I want you to really think about. All right. Now, here's the reality. Here's the reality, right? Um, some of these things are going to be very simple. Some of them are going to be a little more complex. So, therefore, that means some of these things are going to be very much so geared towards beginners, and some things, will have, some things will have a, how do I put it? Some things will have more of a, like more of an ability for you to do on the go. Some things would be best for you to be, doing, while sitting comfortably, looking at a laptop, something like that. Okay. Maybe not something that you'd be doing on your cell phone, but nonetheless, all of these things are going to be applicable on a day-to-day basis. All right. I'm actually going to start off with the simplest of the bunch. All right. You guys have heard me talk about this before. It is the Fear and Greed Index. Now, um, tonight's discussion is pretty simple. Warren Buffett once said, "Be greedy when others are fearful, and be fearful when others are greedy." what he meant by that is when the market seems like it can do nothing but go up, those are the moments where you need to really ask yourself, is right now the right time for me to be buying stocks? All right. And when the market is going down, that's going to be the time where you want to ask yourself, I wonder what's on sale. All right. Now, as you can see right now, we are in a state of extreme fear. Now, this is a very curious case because, well, the market doesn't quite appear to be in a state of fear, right? As of right now, the market is just finding itself in this first bit of drawdown, and we talked about this recently about this bigger drop that we had here, and each subsequent drop in the market just getting bigger over time. And now here we are with a failure to get back to the highs. But either way you put it, the performance of the market has been, pretty good over the past, 3 to 9, so 3 to 5 months, right? Um, so what puts us at a point where we can say that the market is in extreme fear? It's important to remember that this is an index, right? And you're not just going to start to buy this when the stock market, you're not just going to start to buy this when the stock market um, hits extreme fear. You're not going to start. I'm sorry, you're not just going to start to buy the stock market when this hits extreme fear. But this would be a good indicator that some buying opportunities, at least, may be on the way if they're not already here. Okay. Now, you'll be keeping track of this on a regular basis. So you'll have an idea of where the market's been. Um, as I know that the market has, recently hit a point of greed, but there wasn't any extreme greed going on, in the past month or so. Now, when we look at the rest of this particular tab here. And so this you can just Google. You can just Google Fear and Greed Index. And this will be the first thing that pops up on CNN. All right, you'll see it says CNN Business, and this will just pop right up. Just Google Fear and Greed Index. All right. Now, the first thing you'll see is the market's momentum. Now, this is a pretty simple concept. We're tracking the market versus the average price of the market over the past 6 months. So if I put my mouse right here at the end point, as close to the end as I can get, there you go. Then I will see, on average, over the past 6 months, investors have bought the S&P 500 at $7,037. Let me zoom in for you here. Let's zoom in. See that? On average, the average investor has bought the market over the past so 125 days is 6 months in the market. So over the past 6 months, the average person has bought the market at $7,037. Around this point right here, we were buying the market for about $7,600. Okay. Now, what I like to do to help people understand things is just to get a pretty simple idea about um, you know, paying a premium for the market and paying a discount. Now, let's say we consider everything below this line to be that the market is likely trading at a discount. I say likely trading at a discount. All right. Now I'm going to show you guys a few key elements of this particular index, and that's all you will have to be concerned about. And I want you to write these down. All right. So the market momentum is going to be number one. All right. Market momentum is going to be number one. Okay. Um, so no, the market is not always going to be below this price. All right. But even if it's getting close to this price, that's still going to be a sign of a discount. And you'll have the question, you know, whether or not that's enough of a discount for you in that moment. And we'll talk all about that in a few seconds. Okay. But for right now, keeping it simple, near this price or close to this price is where you're going to want to be making purchases. Okay. Um, the next element is going to be what they call the breadth of the market. And this is just, the amount of stocks are hitting new highs versus new lows. All right. And you can see here that as this comes down, that means less and less stocks are hitting new highs. Okay. As long as it's above the zero line, that means more stocks are hitting new highs than new lows, right? But the closer you are to the zero line, the weaker the market is. It's pretty simple. The closer you are to the zero line, the weaker the market is. If you're coming towards this zero line, the market is getting weaker. If you're moving upward and away from the zero line, the market's getting stronger. That's it. Pretty simple. All right. And then you have your. I'm sorry. This is price strength and this is price breadth here. And this is, the amount of volume that's going into rising stocks. But let's keep it more simple here, right? For this particular index, I want you to just focus on two things, okay? The market momentum right here, and come down here, your market volatility. Those are the only two things I want you to focus on, all right? Market momentum and market volatility. Now, here's the beautiful thing about market volatility. The beautiful thing about market volatility is it never lasts long. In fact, see this orange line right here? This orange line is going along with it. This is your 50-day average for the market volatility. The most beautiful thing about this is it's very simple to understand. Whenever the market spikes up and away from the 50-period line, it doesn't last long. Okay? It doesn't take the market long to get back to what they call normal volatility. Okay? It will not take the market long. You can see that, right? You can see that the market spends a lot of time going, with sideways volatility. But every time you see a spike, that spike comes back down very quickly, very quickly, very quickly, very quickly. Okay. Now, the numbers you're going to want to look out for, all right, are 20 and 30. 20 and 30. Right? Now, anything over 20 says we're starting to deal with higher volatility. Okay? Anything over 30 suggests that the market is probably at that point starting to trade at a discount. Right? So if you can combine this right here, so April So you broke over 30 right here. Or you can even say close to 30 right here, right? 29. So March and April here, right? Anything over 30 for this VIX, this is going to be the absolute best time to buy the stock market. Okay? Anything over 30 there, those will be the absolute best time to buy the stock market. That's when everybody is scared out of their minds and they're just selling everything. And well, when they sell these things, they're usually selling them at a discount because by the time we hit 30 on the VIX, well, stock prices are usually pretty depressed by that point in time. Okay? So let's be clear about that. So let me recap here. Okay? Um for your market momentum, right? You have a 6-month moving average here at 125 days, right? And the reason 125 days is equivalent to 6 months because there's only 250 trading days in a year, 251, sometimes 252 trading days in a year. So we use the 125-day moving average to track it in that way. Okay. So the closer you are to this point, so you see right here, in what is this? November 20th of 2025. So when you hit this point here, when something like this happens, when you start to fall back towards this 125-day moving average in the Fear and Greed Index, you can come down here and check the VIX. And would you look at that, November 20th, you were over 25 on the VIX, right? So October and November were some pretty good times to buy. Let's go back over here to the price, right? Here's October right here. Here's November right here, right? If I had a line straight across, so you have what is this? 6,552 was the current price there. 6,538 was the price here. So notice those two prices are very similar to each other. So while this may be a little further away uh, from the 125-day moving average, right? Notice you came right back to that price later on in November, so it was still a pretty good price. All right. Um, you would have seen the market go to at least 6,900, almost 7,000, right, to where the average price is now. Later on, you get this huge drop here in April, and that took you down to where? 6,343. That's not that much lower than this price now, is it? Out of 6,538. Not much lower than this price, but lower nonetheless. Another good time to buy. And you eventually went on to hit over $7,600 on the SP 500. Okay. And each one of these here coincided with a spike in the each one of these drops here coincided with a spike in your VIX. Okay. So when that VIX breaks over 25-ish, heading towards 30, and especially when it goes over 30, excellent buying opportunities. This was just two buying opportunities back to back here. These are moments that I look at and I say these are the moments where we can pretty much buy, anything we want as long as it's proven to be trading at a discount. Okay, pretty simple there. All right, now, so that's our first point there. That's our first element. It is the Fear and Greed Index. All right, the Fear and Greed Index. Um, I want you guys to keep another thing in mind here. Just keep another thing in mind. None of these things should work in isolation. Um, I want you, if you decide to use any of these things, to always try to select at least two of these things. All right. And what these are here to help you do, they are here to help you to actually, they're here to help you make um, better decisions as to when to buy. Um, when I say technical footprint, I'm talking about the technical footprint of institutions. Okay? Institutions love buying at discounts. Institutions love to, you know, control the average price. Institutions love to, take advantage of, higher levels of liquidity. Right? Because those are the times when they can do the most transacting. Right? These guys have billions of dollars to move around. All right, sorry about that, guys. So now, along with the Fair and Greed Index, no, and by the way, I want to point out. Let me just point something out real quick here. On the Fair and Greed Index, notice that your VIX is currently only at about 18.4 right now. Okay. So I do want to point that out. So make that something that you notice, right? It's only about 18.4. So that's not anywhere near the numbers we're talking about. So that's why you need to use these things in conjunction with each other. Okay. Now, I'm going to show you how to find something here that's going to be useful. And it's why I skipped the market breadth and strength element on all right. Sorry about that. So yeah, this is where I start to show you guys some of the a little more technical things than what you saw in the Fair and Greed Index. But this works really well with it. So you're gonna come to barchart.com. You're gonna click where it says S&P 500 here. All right, you're gonna click where it says S&P 500. All right, and you're just gonna scroll on down. Just scroll down, and then you're gonna come up with this right here. It's gonna say percentage of stocks above moving average. It's gonna say percentage of stocks above moving average. The two that we're gonna focus on, well, you can focus on these three: the 50, the 100, the 200. Okay. Now, what this is gonna do is gonna help you time things a little bit better. All right. Um, let's go with the 50 period moving average because this is what we call the first point of support and resistance. All right. The first point of support and resistance in the market, meaning this is the first real test of how strong the market is. Okay. Now, from this point, from the point of looking at the stocks over 50, all right, so this is the percentage of the S&P 500. All right, so how many S&P 500 stocks are trading above their 50-day average? How many of them are trading below it? That's what we're basically asking ourselves here. All right, now, what we like to do is look at the points where most of them are above and the points where most of them are below. Everything in between is, I don't want to say noise, but it's borderlining on noise because you have to know how to read it. For now, I'm not going to go in when we do our technical classes in July. I will go over more of how to read this in a different way here. Okay? We do our technical classes. I will go over how to read this in a more in a more technical way. For now, I want you to focus on how many stocks are above and how many stocks are below. So when most of them are above, you're getting to a point where, you know, you're probably going to be experiencing some extreme greed. Let me break something down for you guys from a theory that they call auction market theory. It's pretty simple. All right. When someone sees everybody is winning, they start to wonder if they can win too. Okay, and that's where greed comes from, for the most part. All right, I'm talking about the not just greed from the perspective of the not just greed from the perspective of the like like as an individual investor. Do I want to sell my stock right now? Do I not want to sell my stock right now? Not just from that perspective. I'm talking about greed in terms of, you know, seeing seeing that the market is making moves, and you know, people just can't help but want to dive into that. You understand what I'm saying? So in reality, um, this is how markets get to the point where we call it irrational exuberance, or to the point where people just think buying a new high is the best thing that they can do. This is how markets get there. All right. Now, when it's all said and done, we look at anything over 70 as most stocks being above. We look at anything below 30 as most stocks being below, right? Anything in between 70 and 30 is going to start to borderline on a little bit of noise because you're typically going to hit at least 70 if the market's bullish. Um, you're typically going to hit at least 30 if you have some really true opportunities going on in the market, right? And I mean true opportunities. All right. Let's take a look at this from a 5-year perspective, and you can see it pretty much goes up and down. See that? So when I look at it from the shorter time frame, right, it just looks like a normal chart that just you can have a lot of. But look at it from the 5-year perspective, as you can see, it's just ups and downs. That's all it is, just ups and downs in the market, one extreme to the next, from 70 to 30, and well, below, of course, below, above 30 to below, above 70 to below 30, above 70 to below 30. That is the natural state of what's happening here. So what happens is the market looks at this and says, well, because most stocks are trading below this average, um, I must be able to find opportunity. Okay, and that's why it goes right back up afterwards because people find the opportunity there. So you can look at this and just keep it really simple, guys. Listen to me. Keep it simple. As I said, when it goes above 70, right, you might want to start to think about, we look at this as excess. We call this the excess phase in the market. So this is where I'm going to be looking more often than not to take my profits from the market, that kind of stuff. I want to just take profits. I want to do those types of things. Okay. Um, when I look at you know, um, when I look at the market below 20 and below 30, or even look, you see right here, got close to 30%. When I look at that moment, I'm looking at that and saying, okay, there must be opportunities for me to make a purchase. Okay, this is the panic phase, the discount phase in the market. All right, let's go back. Let's go back. Wait a second here. Oh wait, no, that was it right there. All right, here we go. Okay, never mind. So I got to go back this way. All right, here we go. So if you wanted to, again, I'm gonna show you some more technical things later on. But if you wanted to, you can compare the 20 to the 50, and that can work as well. All right. Now, this is the stocks over the 200 period moving average. Okay. The 200 period moving average is a longer term moving average. So, you know, uh, you can have most stocks trading below the 50 period moving average, but most of them trading above the 200. Right? The 200 is a sign of longer term strength in the market, right? And you can see it doesn't go below 30 as often as your 50 pre-moving average does. Okay, but let me show you. Look, I mean that goes to show you that when it does go below 30, those are the best buying opportunities you're going to get in the market. If you have less than 30% of the stocks in the S&P 500 trading below their 200 period moving average, this is the moment where you want to deploy the most capital. When you want to put more money into the market than you would have otherwise, right? If I own a 50 stock portfolio, this is the moment where I'm buying all 50 names, just to give you an example, right? Whereas up here in this area, in that 40 to 60 range, you know, I may just be buying that one stock here and there when the stocks, over 50 shows me something else is going on. Okay. So this is your secondary one. These two right here can help complement the the market momentum and the volatility index. So when the VIX breaks above 25, um, above 30, then I can look here. I can look here and I can say, well, I wonder how big of a discount am I actually getting? And that's when you come over here. Okay. If you wanted to match this up with the Fear and Greed Index, um, what you could do is you could use the stocks over you could use the stocks over 100 because we have the 125 in the Fear and Greed Index. All right, so you could always use that if you wanted to. All right, right here, the stocks over 100. Okay, and that would be the closest you can get to the 125. All right, and it's the same thing, but so just imagine as the market starts dropping towards the 125 period moving average, but most stocks in the market stay above it. All right, like we right back here in November, so that's a sign of some strength there. Right back here in November, notice a lot of times it doesn't really get all the way down there. You can see here, 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 here. So that's about 4 buying opportunities in the past year. So if this happens and it gets accompanied by a VIX over 30, or it gets accompanied by the entire SP 500 trading below its 100-day moving average, then perfect, right? So you can use this instead of the market momentum and add the VIX with this if you wanted to. So those two things can work. All right. Um, Next item on the list. Again, I'm showing you guys a bunch of things today. You can decide what you want to use. Next, you're gonna come over here. You're gonna go to the You know, you can. I typed in the SPY, right? Typed in the SPY. That's what I typed in. You can go right to the SP 500 that I was on as well. It's up to you. But you're gonna come right here. See this menu on over the side here. Now this menu may be like this. Or you may have a menu right here. Okay. What you're gonna do is you're gonna click right here where it says Traders Cheat Sheet. The Traders Cheat Sheet. And when you first get here, it's gonna look like this. Show what it looks like when you first get here. It's gonna look like this at first. Okay. And that's a lot. That's a whole lot. This is not what we want. We don't want this. All right, we're gonna do. We're gonna uncheck everything. You're gonna uncheck everything except for RSI. Okay. And what you're gonna do is you're gonna come over here and you're gonna check where that discount is at. You're gonna come over here and you can check where that discount is at. So anything below 30 on the RSI, especially below this 20.647-ish, right? That starts to be where you may see the things you're looking for, like more stocks trading below their 50-period moving average, more stocks trading below their 100-period moving average, the market trading below that 125, the VIX over 30. A lot of times it can happen here. Now, let me just point this out to you right now. If you check this, if you check this trader's cheat sheet, and the market is below this 30% on the RSI, while you come over here and the VIX is over 30, if both of those two things are happening at the same time, that is one of my favorite technical footprints in the market. One of my favorite technical footprints, I'm going to repeat it, is when I come over here and the latest price is below this RSI at 30%, and on the VIX, it's above 30. When those two things happen at the same time, usually great buying opportunities in the market. Okay, we're gonna look out for that. We'll look out for that. Okay, now that's it for the bar chart stuff. The next thing I want to show you guys is next thing I want to show you guys is, and we only have two more to go. Two more to go, and then you guys can ask some questions, right? Two more to go, then you can ask some questions, right? It's not a lot. Right? What is that? 1, 2, 3, 4, 5 things I had to show you guys, right? Okay. The next thing here is on Morningstar, right? You can use market barometers. All right. So you come to morningstar.com, right? And you can see 1 week, 1 year, so on and so forth, right? So, usually you can compare the 1 week and the 1 year. You can see the large caps are, outperforming. But where I really like to go is here, markets, then go to market fair value. Okay. Now, Morningstar is a firm that tracks the entire market as a universe, per se. And then it will decide on, the value of these businesses, and it uses the value of those businesses to essentially determine what the value of the sectors should be and what the value of the market should be. All right. So as you can see right here, it says the market is undervalued by about 7% after that last drop in the market. One of the best opportunities you are ever going to get is when this number is more like 15%. Okay. And the number is more like 15%. Let's go to the 3-year view. See that? Look, 15%. Look what happened right here, around 15%. 15%. Didn't quite get to 15% here, but you can kind of get a clue here. All right, there's your 5 years. So 15% and 15 to 20% works as well. right? When the market's undervalued by 15 to 20%, those are going to be your best opportunities by far. Okay, so you can come over here, you can check this, and it's going to be a really great barometer of like the true value of the market itself. These are very simple things to use, right? They're not that difficult to use. Now later on, again, when we do our other sessions, I will make sure that I show you guys more of the even more of a technical factor of um looking at the different sectors. But for now, let's focus on the market as a whole. As you can see here, anywhere between 15 to 20% um, is a really, really great point in the market. And if you were to check where the VIX was around these times, this is November 1st, October 31st, around this, 2023. Let's go back over here to check the VIX. All right. Oh, no, I forgot. They don't show you that far back here. All right. I forgot about that. I can go over here to the VIX over here, though. I got you. So let's go to the weekly chart. Keep it simple. All right. Here goes 2023 right here. Right where the VIX go. Wait, no, I'm sorry, 2023 right here. All right. You can see here, got close to that 25 again. And these points right here were also on that chart. See right here? See right here? Let's go back over here to the you see that's that same point right here. Same point right here. Okay. So any spike you get in the VIX, you could also check this. You could also check this point right here to see, are we undervalued by at least 15 to 20%? If so, great buying opportunity. This does not mean I can't buy in these areas here, but in these areas, I want to be very careful. I only want to buy the select names. I want to buy the names that, you know, that could still see some upside. These little pullbacks that you see here were opportunities to buy those one name at a time type of type of opportunities. Okay. Um, then last but not least, um, this one's a little more difficult to you know to get a grip on, but this is the overall valuation of the SP 500, and you know we usually like to see the market pulling back off of these highs, right? And these end up being great buying opportunities here as well. You can see, how this this plays out. Now you can go to the one here that says the Shiller PE ratio. This is on multiple multpl .com, and this one reveals a much better picture. The Shiller PE ratio on multpl multiple. Okay, reveals a much better picture. So you can truly see when the market is just out of this world, right? These certain points here, here, and look at where we are right now. Almost the most expensive we've ever been relative to inflation, right? So what you want to look for, this one is not about timing a purchase. Okay, this one is not about timing a purchase. This one is actually more about this one is actually more about um you know this one's actually more about timing your profit taking and your thought process around the market. So don't use this one for buying opportunities. Use this one to keep your mind in check, right? You guys hear me saying recently that I'm not in a mode of buying everything right now. When April came around, sure, right? I need to see those in a moment like this, when the market is this overvalued. or this expensive, I have to see the market trading at those 15 to 20% discounts, or have to see moments where the VIX spikes over 30 and things of that nature. Like I have to see those things. Okay. And those are the only times I am going to think about buying the market. All right. So these are your 5 key elements: the Fair and Greed Index, right? The stocks trading above or below moving averages, so above the 50, above the 200, above the 100, whichever one you choose to use. You don't have to use all of them, but you can use them in combination with each other if you wanted to. The trader's cheat sheet, where you can just take I know exactly where the market's gonna hit 30 on the RSI. Like that number I can look at for myself. And by the way, you can go over here to hit stocks. We'll go to bar chart right here. One second, where 1 second. We'll get to that. We'll get the comments in a second. Um, no problem, no problem. So yeah, so basically, you can go here to the SP 500 as well, and you can do the same thing. So S&P, and then you go to Trader Cheat Sheet right here as well. All right, and you can see it for the SP 500 as well. Look at that, 7,031. If you go back over here to the Fair and Greed Index, and you say, well, what was that what was that 126-month average again? It was about 7,037. So pretty much the minute you hit that 125-day moving average, or the minute you hit that 6-month average for the market, guess what ends up happening? You end up having a market that's pretty oversold. So at this moment, I would look at this and say, well, I'm not certain how much further below 7,000 we would go, but I know that at 7,000 is probably going to be a decent opportunity. I'm going to say decent, right? But bigger opportunities are probably to come down the line if that shows that the market's not quite done when we get to that point. The next one was the market fair value on Morningstar. 15 to 20% discounts. You can see them very clearly. And these are all points when the stock market itself, the entire market was trading at a discount, and you can tell based on the fair value of those stocks. All right. And then your Shiller PE ratio. This one, not about thinking when do I buy, but thinking about when do I take a pause? When do I take a break? When do I need to see bigger discounts in the market before I do anything? This is going to be that moment when you're paying so much for earnings right now that it makes no sense to not wait for a discount. Right? Now, let's talk, guys. Like I said, now that we've looked at these points, you know, any questions, anything of that nature that anybody wants to, you know, anybody wants to get out there. Let's start with questions first, and then we'll go with comments after. All right. Does anybody have any questions? Any questions? Any questions? If you're in the audience and you wanna get some questions off, talk to me. If you're on the Twitch stream, you click the link at the top of the room. If you wasn't over there, and you'll see it says watch us on Twitch over there as well. All right. Does anybody have any questions? All right. 50-question exam on the way. Everybody got this down pat. Joking, 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 joking. Yeah. You said you only buy in those conditions, correct? But that's just when you deploy more capital. Yeah. So, if conditions are not at their peak favorability, then I'm going to focus on buying single names one at a time. But when those bigger opportunities come about, I'm a buyer of everything. Like I said, if I have a 50 stock portfolio, which I do, those are the moments when I'm buying all 50 names. Okay, that makes sense here. All right. So if the market showed me that we're at a 20% discount on the Morningstar chart, and the VIX is over 30, the SPY is oversold. We have almost every stock in the market is trading below their 200-period moving average. Right? What am I going to do? I'm going to buy everything. What is the market proven? The market has proven over time, over the long run, that you know we will recover from those moments, especially the companies that are quality, right? That's why we go with objective investment quality, right? So especially those companies will always recover in the long run. We don't buy junk; we buy the best companies. Talk to me, Shay. You have a question?
I'm just a little bit mad. A phone call. We at that stage now with the COVID 30 in our side?
No, not even close.
No.
Yeah, no, not even close. We had that in April. That was our opportunity then. Right. Um, Anybody have any more questions or any comments? Any thoughts? If there's no questions, I'll take some thoughts. Anyone? Good evening. Good evening. Um, Aware, do you know you're unmuted? Were you going to say something?
So sorry. I am a live sorry about
No. It's okay. It's okay.
name, but yeah.
All good. All good. All good. Moji, talk to me.
No, nothing. Just arrived, and I'll definitely be checking in on the replay.
Jay, I don't know how long get us you because I'm in that area that I'm not getting good reception. But just on that comment you made about April,
Yeah.
there's a lot of good information provided just now. And I mean, to me, like, I was just looking at the news. I didn't know, what's this, Holmes Mountain said something that triggers a market time to buy. It's good to be able to put a number to that also. Man, that's just my
Yeah, definitely. That's you know, because I started off in the market already having some knowledge. This is one of the first things I started to do was I started to look for um an idea of exactly how I was going to handle myself in the market. And I was, in search of that for the first few years and just kind of piecing it together. And I started to see, okay, cool. Because, what to buy is one thing, when to buy is another. Right. And we'll be talking again a little bit more about the more technical side of things coming up. But these are some really solid points that I found throughout my journey. And if you guys have been around a while, you can see these things repeat themselves in every one of these lessons. That's because these are the true things that I've discovered over time that can really help you better time your investment strategies. And I haven't found anything else that's worked better outside of credit spreads. But you know, I don't want to do anything too technical tonight. So I left the credit spreads out of it. But definitely some other time when we want to go advanced 101, or I guess it'll be 102, huh? Value investing 102. We'll do that. Anybody else? Well, no, go ahead.
How often are you looking at these when you see the market hitting key levels or deviations?
Today was actually a perfect day to have this class because today are days of reasons why I look at this. When the market's just running higher, this one right here is the only one I really care about. And the fear and greed index, I'm looking to see if we're at extreme greed or not, that kind of stuff, So on the biggest days in the market, I like to check this stuff, you know? Like when it's obvious that there's a fuss about the market going on right now. You know what I mean? Because people tend to make a fuss about the market at peaks and troughs. Meaning meaning like when things are peaking out, that's when people tend to gather that opinion that, it's not over, you know? When things are bottoming out, that's when people tend to say it's all over. Right? Depth of the market's never coming back, so but if I go from a natural flow of things, I'm looking at this about maybe once a week. If I had a natural flow of things. There's at least one day a week where where something's happening where I wanna check these things. Look at your look at your what do you call it? As far as like when like let's say you look at your portfolio, right? And you know the market's up, but something's happening where it just seems like there's more stocks down in your portfolio than there should be. For example, right? Go check the market, see what's going on there, right? Um, you know, things like that. I get more so triggered to look at these things. But and I'm talking about if I was it's just a natural flow of things looking at it because if I was talking about what we do on a day-to-day basis, then it's going to force me to look at them almost every day, right? But now we're talking about just naturally looking at it. You know what I'm saying? You know what, Cecily? I was talking to myself.
Mm-hmm. Heard everything you said, though.
You heard it. You heard it on Twitch.
Off Twitch, just pretend I heard you.
Oh, gotcha. So yeah, I was unmuted on Twitch, and so you could hear everything on Twitch if we were there. So let me just repeat that. I was saying that pretty much on a like for me, maybe like once per week, I'm looking at these things. If I was more so going on a natural flow of things, and I'm also triggered to look at it by what's happening in my portfolio, what's happening with the market, right? Like when I see those moments where we're having those bigger days of the week, stuff like that, and that's usually going to come along with economic reports. So, the PMI just came out today. I may be more focused on looking at all these things. Like where are we?
Okay, for you like right into the next question. So you're tying that with what you talked about the other day, like the most important economic report, or
Right.
there's nothing happening on the calendar for you. Is that a weekend review, a beginning of the week, midweek? Do you have a preference or no?
To review these things.
Yeah.
It's usually gonna be a beginning of the week thing, not an end of the week thing. Which, by the way, we were supposed to look at the commitments of traders today, wasn't we? No, nobody reminded me. Nobody reminded me.
Conference.
Got you. But yeah. So when I'm looking at those types of things, like you just mentioned the conference board. So if I'm looking at the employment trends report, I'm probably going to leave from there and say, okay, based on what that's saying, let me go look at everything else. Right? I mean, is this lining up? let's say based on the employment trends report, things should be going really well. But I come over here and I see extreme fear. Yeah, cap.
And that's where, once again, you can identify a divergence or something.
Right. Exactly.
Okay.
So I don't want to just stare at these all day for no reason. I want something to lead me, push me in that direction. You see?
Yeah.
So that way I can go and I can say, oh well, the non-farm payrolls came out, right? And the non-farm payrolls were extremely, positive for the economy. I mean, more jobs added than we added in the past 5 years, right? But yeah, but the stocks are, like,
Yeah.
everything's just on real quick, just like everything's just seem to be untethered to that reality, pretty much.
Mhm. And another thing, when you were, I believe, looking at the over 50, over 200 reports, and I'm like, okay, some of those were events where there were great buying opportunities, were like big shots. So those led to great opportunities as well,
Mm-hmm.
like the good old carry trade.
Mm-hmm. Right. So something like that, right? One of the first things I did was go and look at the stocks over 50.
I do remember that. Yeah.
It's one of the first things I did. I'm like, we're collapsing, we're dropping. Okay, let me see how many stocks are still over their 50-period moving average. And like we were still pretty elevated before that came in. So okay, so nobody's prepared. See, that's how I looked at it.
Yeah, and I think it happened prior to that when, remember, several years ago, the Bank of England,
Mm-hmm.
that was a global shock as well.
Yep. So it's those moments. Emoji, what you laughing at? What's up, Prince? Emoji was over there listening on Twitch and Clubhouse, and she still didn't tell me I was talking to myself. That's okay. What's up, Janella? What's up, Blanc? Kenny? Jose?
So right now, right, looking at this every single day, you probably just going to, you know, looking for the extreme. Is that correct?
Um, looking at it for the extremes, but you're looking at it during periods where something's going on, like I said. So, for example, the first of the month comes around. First business day of the month comes around. That's going to be Wednesday of next week, right? You certainly want to look at all these things. It's going to be PMI reports, all that stuff, right? Then going to come your non-farm payrolls, and so the beginning of the month is going to be a lot of this going on. A lot of looking at this stuff because that's where your biggest reports come out. After that, then it's more of a being, like I said, triggered to look at it by what's going on in my portfolio. Right. So if I see that I'm looking at my portfolio, it says, oh, the market's up, big today, but like if I go to the let's go over here real quick. Go stocks, go to stock market momentum, go to market momentum right here. Let's say this says the market's up big today, but like yesterday, guess what? Most of these were down. So cool. Let me go look. Let me go see what's going on with the rest of this market here. Let's see what's happening. And sure enough, it looks like the market's losing strength. All right. So that's a sign some opportunities may be coming. They may be on the way. So so that's why I'm looking at it at least once a week. So at least once a week something happens, in my opinion, that warrants actually. And I can look at any one of these things. Look at any one of these things. But for the most part, when there's a really big move in the market or something happens that's really big for the market, I love to go to the stocks over 50. Or the stocks, like I said, you could do stocks over 100 to keep it simple. But I love to go to that route and see exactly, see exactly how that's playing out for the market. Um, they can't be priced in until they become. Uh, Go ahead. I'm sorry, we can't really hear you breaking up there.
Sir.
Say that again. Gotcha. Um, yeah, we can hear you now. Yeah, we can hear you now.
Okay. What I'm saying with I was trying around the idea is maybe setting up AI to be able to expose information all that in one shot. Rather than having to dig around for it and pull up various plays. Just set up AI to be able to pull it from all the various locations, different sites, and just put it on the file all together.
Gotcha. Well, the question is going to be, can you actually trust the information? Um, you know, when it comes down to AI, for the most part, man, you can do a lot with it, but it's a lot easier to trust information that you give it than to trust information that it's giving you without any input at all. So either way, I'm going to end up having to go to these sites and snatch all the information up. But nothing wrong with that though. But I wouldn't trust it to just go get the information for me and bring it back. I wouldn't trust it to do that. Just being honest.
That was clear.
No, I know that. I know that part. But depending on the information, it's likely not to pull the actual information. It's likely to just hallucinate information or just tell you it can't grab it. You know. But yeah, because we're so a lot of these sites block third parties. Like like if you had an API from that website, then that'd be a different story. Like but every single website's not going to allow you to do that. That's my point. So like some websites will, some websites won't.
I'll try to see how it works.
Yeah. Let us know. So that'll be cool. In my experience, you get a lot of in my experience you get a lot of cached information. Like cache information. You get a lot of that, which isn't going to be the actual information. Um,
Yeah.
Yeah, no, James, he's not talking about those reports. He's talking about like PMI reports, you know, Fair and Greed Index, that kind of stuff, you know. And what I found is, you know, that it's usually not the up to the minute information. So like you could be getting old information, um, because it has to run through a search um based module to get the information to begin with. So like sure, financial information could work, but you know, for a lot of that other stuff that we're talking about, it's up to the websites whether or not they allow you to use it. And you can use a proxy if it's just going to be you using it. You can set up a proxy to do it, Christopher. I've done that. That would work. You know, where the AI can essentially run a proxy and scan the website and pull the data in. You know, as long as the proxy isn't block, you know, because eventually they'll block the proxy sometimes. So yeah, I just stopped. You know, and to your other question, James, you know, something has to be public first for it to be priced in. So you can't really say PMIs are priced in before they become public. So you know, yeah, and PMIs are more of a, you know, used for more of a predictive side of things. It's to take more for the economy than the stock market. So we're not looking at it for the stock market. We're looking at it for the economy more than anything. So I'm looking at it and thinking, you know, in what direction is the economy headed in? And you can get ahead of the market a lot of times. It can tell you what commodities are in short supply, um, you know, what type of materials and other things are in short supply. Electronic components are in short supply, that kind of stuff. It can let you know what's going on in certain industries. So like let's say in I don't know, auto manufacturing, to keep it simpler. Let's say in auto manufacturing, they're starting to experience supply disruptions, and at the same time they're just firing people left and right. Lets me know that there's some weakness in auto manufacturing that I may not want to be buying right now, and I may wait for, you know, a better opportunity. Um, Along with the PMIs, other reports that are publicly available are like the Beige Book from the Fed. The Beige Book actually tells you the Beige Book actually tells you what's going on with the economy, um, and essentially it's coming directly from the Federal Reserve, and it's actually grabbing information from each one of the banks and aggregating it into one report. So now you get a, you know, as close to a firsthand viewpoint of what's going on in the economy as you can get outside of the PMIs. You know, there's also the Employment Trends Index. So just go to the conferenceboard.org as well. Um, they have the CEO confidence and the Employment Trends Index, as well as the leading economic index. Those are some great reports as well, that I like to look at. And you know, you just your economic calendar as a whole, which you can go to Trading Economics and go to the calendar and set it to just look at the U.S. And you'll be able to just look at just, you know all the reports that are, that are available on a regular basis. And it's going to be a ton of reports that come over there, and they'll put stars by them to let you know how important they are. They'll highlight them in red, or they'll make them bold to let you know that this one's important, right? So there's that as well. But yeah, man. Like I said, if you guys plan on doing the AI thing, let me know. Let me know how it works out. Like I said, you can like I mean I know that I know of ways that you can do it, but I swear it almost takes more time to do that than it does to just do it myself. You know, I don't know. So I'm going back and forth, snapshotting things, that kind of stuff. Or like I said, you can set up a proxy if you want. But the amount of time I spent putting together the proxy, I'm going to spend less time this year looking at those things myself. Um, so I get that you're saying your question still stands, but your question was already answered. Their reports are not known until they're made public. So nobody has access to the report until it's made public. So you can't price in the unknown. Only thing you get out of the unknown is uncertainty, and that just leads to a market that goes nowhere. But retail traders, and the level to which that they look at information is the real issue, not their access to information. Anybody can act on the information, and we ourselves are constantly ahead of institutions and making decisions. So I can tell you from firsthand experience, everything I'm talking about right now has led to us doing things sometimes months before institutions even start to make any impact on it. So I mean, you have to actually put it to work first, and going based on the logic that you're bringing to the table right now. That in itself is a is a mindset that's implanted into the retail environment. You know, you have what they call the efficient market theory, and that's to say that uh, everything that's known might be priced into the market, right? But like I said, it has to be actually known first. So, like, you may get a report, you may get a PMI report that reveals some information that can lead to you focusing on a specific sector of the market, and that particular sector of the market may have been undervalued or you know um, trading at a discount for months, right? Um, you're not gonna do away with months long discounting in a single day. That's just impossible. So that's my point. You can't react to information that you don't have. I'm not sure if you're understanding that or not, but I'm also not sure there's a better way to explain it. If you don't have information, you can't respond to it. Once the information is released, people will respond to that information in different ways. So how you respond to the information is going to be different. How you respond to the information will be different than how I respond to it, right? So you may get the PMI reports and run to technology stocks. I may get the PMI reports and run to industrial stocks, right? So it's not going to be some broad brush response to every report. Even institutions don't all do the same thing on one report. They'll act differently themselves. In fact, actually, just today, Moji brought up a point. Bank of America creating products to rid themselves of risk on the S&P 500. Um, you know, essentially betting that the SP 500 will either be flat to higher over the next 3 years, and they'll get about an 8 to 24% return on the max. You know, yeah, no. You're good, James. You know, but yeah, like like I said, like so the SP, so with Bank of America, with what they're doing right now, that's kind of proof right there that everybody's not going to act the same on the information that they're getting. You know, I just saw people already taking out credit default swaps on Tesla. I mean, not Tesla, on SpaceX already. The company just got here. You know, most people thought that, oh, the IPO is out, you never get this price again. Here we are. We're already trading below IPO price. So I don't know, man. I think there is a point at which the information is already over and done with, but I don't think that point is day one. I think it takes time to price in a lot of different information. Some information may be priced in on day one, but most information is just not. Most information takes weeks to actually price into the market, and people just don't realize it. Because the market tends to, like every single day it wants to respond to something else. Trust me, I'll tell you this. Um, 3 months from now, we'll still be dealing with the oil shocks that came from this Iran war. It's not over. Trust me, it's not over. We'll still be dealing with those shocks. Yeah, it's definitely still true in large cap stocks. It's definitely still true in large cap stocks. Like, okay, I'll give you a prime example. You might think that when the war in Iran kicked off, that all the stocks that um like by that time or by now it would be too late to buy defensive stocks, like stocks that make weaponry or stuff like that, right? Well, guess what? Those stocks are trading at discounts right now. So it's actually just starting to become a good time to buy those stocks. If you go look at Lockheed Martin, go look at Northrop Grumman, go look at all the stocks that that make weaponry, they've been getting their butts kicked while the war's been going on. And so like that's a prime example right there where it's not about whether or not information that's released is already priced in. It's about whether or not you're looking at the right information. That's what it's really all about. That's kind of that's a better way for me to put it. I should have put it that way to begin with, right? It's whether or not you're looking at the right information, not whether or not it's priced in, right? Because we may be reading into the wrong thing, and that's why a lot of people think information gets priced in so quickly. They're looking in the wrong direction, right? Like, somebody says, the economy is booming, and so on and so forth, and while somebody's looking to buy into the market where they may be too late there, somebody like myself may have said, "Oh, the economy is booming. That's the perfect time for me to hedge against my portfolio." Like, how are you looking at the information? Because that information tells me that people are likely exuberant, and that's a great time to hedge. So institutions aren't acting on the information like we think they are. They're not acting on it. They're not buying after the information comes out. Looking for the next move after the information. That's how you're supposed to deal with it. You're not supposed to say, "Oh, this is happening, so therefore I should," boom, 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 right? You're literally, you're literally looking for like what comes after that information. That's the we're always we're always trying to find ourselves like in the flow of things when when we really should be looking at, where do things fork off next? Like, like where do they, where do things split off into next? That's how I'm looking at it.
Is that like looking into it?
Say that again.
Into it.
Yeah. Oh, yeah. Yeah. Right. Right. Like into it. Right. For example. Right. Um. Like when we were looking at that stuff. Right. Everything's not trading at the.
But it was trending down hard. Then the rest of the earnings was ramping up. So, I mean, we're letting God contribute to the fact that we absolutely falling slow. They feel like,
Right. So when
and it's just my big flat wall.
right. So when I'm looking at that.
You see, like,
Right. Right. Exactly. You know. And and yes, we do use valuation models, James. Yes. We are talking on a discounted basis.
It's all a process, right? Duran, I mean, honestly, you get information, it's efficient in one manner, not perfectly so, because information also needs to be interpreted.
Right.
It's interpreted differently, consistently. So, yeah, it takes a minute.
Right. Exactly. Like if somebody says and I'm gonna give you another perfect example. Aware. Watch this. If somebody says tech is booming, right? It has been so true over time that maybe that information right there says I should go look towards, energy. And how many times have we done that, Cecily? How many? I mean, so many times. Long energy, short tech, right? We've done that so many times. And you don't have to necessarily short tech, like so it's not a literal thing. It means simply put that in those moments, energy is likely to outperform on the back end of that tech outperformance. And it's happened consistently, consistently, over the past 6 years. So again, like when you get the information, it's not about what, like you can't just look at the information and say, well, they say, tech is booming, like this guy in the chat said AI, Um, you can't look at it and say, oh, they say AI is booming, so I'm going to go find an AI stock. All right? No, you say, okay, you know what? They say AI is booming right now, no problem. Um, you know, Based on the level of exuberance going on there, they must be ignoring something. See what I just did? What are they ignoring? Talk to me, Aware. Go ahead.
No, I'm agreeing with you. I totally agree with you. It's the same thing about like, the software. You think about it, everybody was basically ready to ditch software. Where is this place? It's a matter of the understanding and the process. Yeah. So,
Right. Like as if we're really going to get rid of software.
right.
Imagine that.
It just
Right.
it's not going anywhere.
Exactly. So I already made some software investments, and I'll wait until they till they get ready. You know.
And at the time that they were talking about it and it was going down, that was the time that discount price you should have bought it then.
Exactly. Right. Right.
To bring the market, the greed in the market. I think right.
Good.
Yeah, I was listening. I totally agree with your presentations.
Much appreciated. And I'll say this as well. Another thing here is that, you know, um, oftentimes the person that's invested very well and already diversified, oftentimes will experience all of what's happening, and then that offsets their portfolio in certain ways. Then they have to determine how to get it back into balance and find other things like because with AI, I didn't have to go and buy any AI stocks. I already like all of a sudden, I had infrastructure names that were all of a sudden in great favor, you know, and some tech names that were all of a sudden in great favor, like the memory chip, memory stocks. Seagate has been doing wonderfully, right? I mean, Seagate of all stocks, right?
Right.
Just won't stop going up, and so, but I don't even like at this moment. I don't even care about Seagate. You barely hear me talk about Sterling anymore. I am thinking about what's next. And so for me, I'm like, okay, cool. I bought a little bit of defense. Bought a little not defensive, so not like consumer staples, health. Well, but we did get some healthcare names, but you know, which they were also under attack, and people forgot that, right? Like AI came around, they forgot healthcare was getting kicked in the mouth, and then you got to ask yourself, um, like, is Robert F. Kennedy Jr. going to really do away with the healthcare sector? I doubt it. I think as soon as you know, uh, I think as soon as Trump and this guy are out of here, it'll be back to business as usual in healthcare. And that's going to be another issue that people were, hey, if you weren't already thinking ahead, then whatever. Talk to me where.
No, it's with my portfolio. Then almost made some. Well, I did make some changes, but I sort of brought it back to where it was before because it was sort of. I mean, I just needed to do a little rebalancing, but yeah, I sort of brought it back in healthcare. I see that coming now. It's like if you're visionary, you actually see it. It is coming back around. You're not going to get rid of it.
Right.
The AIs and the quantums will be used in that sector.
Yeah.
Well, as long as we have health, we will need that. Yeah.
Intuitive Surgical. I've been, investing in that one.
I bought that when it was $4 when it first came out.
Nice. See that? Yeah, it's like like the amount of things that you can just look ahead to. So just I'm gonna end it on that tonight, guys. Because these are sessions that are meant to be uploaded later on, and you guys can go look at them later. So I will upload this to YouTube, in time.
Okay.
Trying to upload them, trying to upload them, one at a time. It takes so much longer to upload these things to YouTube than it used to. These particular sessions here are Mondays, Wednesdays, and Fridays at 8 p.m. All right. Mondays, Wednesdays, and Fridays at 8 p.m. Yeah, Eastern. And you know, we're about to end the month of Value Investing 101, and then we're going to be going into Technical Analysis 101, or I don't know what I'm going to call it yet. How to Trade 101 or something. I don't know. For the month of July, where we'll be talking pretty much about trading strategies from both the technical and and a fundamental perspective. Like that's going to be a pretty interesting set of sessions there. I'm gonna be working on that curriculum. I already have most of that curriculum ready. But I'm gonna make some changes based on what we talked about these past couple of weeks. So, but yeah, Mondays, Wednesdays, and Fridays at 8 p.m. Eastern. Um, you know, definitely come on and tap in.
I definitely will. I enjoyed it tonight. I was busy. I was multitasking, but yeah, I will definitely tap in.
Most def. Let's see here. So, for those that are already subscribed to the Twitch, you know that as soon as I close this out, the replay will be there. All right. And I uploaded some more of the replays to YouTube this week. I'm gonna be uploading some more tonight and tomorrow. So look out for those as well.
Good to know. I'll go catch some of those too. So you're on YouTube. Okay.
Yeah, if you click the link at the top of the room, you'll see it. You'll see the subscribe to YouTube link there. Also, you see a look to the playbook for stock investing, which actually is a book that I wrote.
Your book.
Yeah. And yeah, it's a lot. It's a lot of what we've been discussing in these sessions.
Okay.
Basically, what I did is I put together a framework for investing, and essentially it helps people to and this goes from a professional, from anywhere from it could be a novice to a professional.
Right.
It has something for everybody. Like even professionals, for things that they may not have thought of when it comes down to how they want to deal with management of capital and portfolios and things of that nature. But it really just walks you through what I call the guided alpha model, and it means pretty much exactly what it sounds like, right? It's essentially guiding you into alpha related strategies, strategies that are designed to outperform the market. All right, and it's a pretty dope system that people have been certainly benefiting from as of recent, and I'm happy that I was able to get it done. It took me a couple of years to actually write that book, but I'm learning.
Congratulations.
Thank you.
We're gonna get. Yeah, I'm going to do that this weekend.
All right, excellent. Let me know what you think. All right. All right, guys. I'll catch up with y'all. Well, for some of you guys, I'll see y'all tomorrow, 11 a.m. And I'll think about sending y'all the new portfolio tracker at at a decent time. I might send it at 11:50. I might send it at 10:58 a.m. just because Moji wants it earlier than 11. But
I hope you wake up and act right.
yeah. Ah, goodness. I will catch up with y'all later, guys. Everybody be blessed and stay well. And we will talk soon. Later.
Thank you.
Good night.
Thank you so much. Good night.